So, welcome to January's version of What's Brewing. Thrilled to be here in Birmingham, Alabama, with our Chief Investment Officer, Mr. Rick Waddell.
Hey, Sherry.
Good.
Thrilled to be here. Thank you so much for having me on the podcast. I appreciate it.
Happy 2022 to you and to our listeners as well. So let's get straight into it. Rick, give us your wisdom. Tell us what you think happened in 2021, some key things, kind of a recap there of markets, economics, politics.
Briefest of recaps. From an economic standpoint, which is where I believe all this kind of starts. As was widely predicted, we got the restart of the U.S. economy.
Yes, we did.
And
Thank you.
It's hard to remember where we were last January, but I remember where I was, which was locked in the basement of my house. And most of you were there too. Some of you that are in Southern Florida were not there, but most everybody else was locked in the basement of their houses. And, over the course of 2021, we basically opened the doors, let everybody back out again. We got this wonderful thing called revenge spending, right? Where people were going to, spend their way.
Demand.
Pent-up demand. I lost a year of my life. And so we saw
I want it back.
Right. Yeah. We saw GDP growth really at rates that we have not seen really candidly ever. And certainly not in the modern era. So, wonderful economic growth, pretty good market returns on the back of that. S&P 500 was up about 27%.
Which is crazy.
Absolutely crazy. I think we have to remember that the S&P 500 is not necessarily Main Street. So there's still certainly some restaurants and other consumer-led businesses that aren't necessarily doing that well.
That's a tough time.
But your larger companies were able to pivot and rebound very, very, very strongly. So that was fantastic.
And interesting, the Dow.
Yes.
Dow was not, normally those two components track closer.
Normally they do. I think about it in terms of value versus growth, which I know we're going to talk about a little bit later. But value driven stocks, up 22%, still a great year. I hope that no one is going to look at a 22% return on anything and say that was a bad year, because that's a fantastic year.
Sure is.
But the growth stocks, the Amazons and Googles and Netflix of the world posted 31% returns last year. Again.
Third year.
It just, keep chugging along. And it's one of those things we always talk about. Just because something maybe looks abnormal doesn't mean it can't look abnormal for another year, or that it needs to mean revert, immediately. So, I always like to say, just because something looks stupid doesn't mean it can't get even stupider. And when you look at some of these valuation gaps, you can kind of see that in certain places. So, but certainly a great year for the market. Bonds did not have a great year, but equities certainly drove a lot of returns.
And we definitely will have some questions on the bonds toward the end of this podcast. So we went into and we progressed through the pandemic with a slower growth economy, or that was the pitch from everyone saying, okay, well, we were sort of topping out here. We're kind of coming to a plateau. And then all of a sudden pandemic hits, we go down, and then straight up.
Yes.
So where are we in the whole thought of growth for 2022 looking forward? What do you...
I would just comment that there's still a lot of pent-up demand. So, the thing about the pandemic is it's lost on a lot of people exactly how much damage was done to U.S. gross domestic product. We are back above where we were pre-pandemic, but not wildly so. And you remember that we missed a year of growth there that we would normally have.
We did.
So, I think most economists' expectations for 2022 are for GDP growth that's more in line with historical norms. So call it, mid 2s to 3%, sort of leveling off by the end of the year. That's, from an economist standpoint, there are very clear demographic and productivity factors that go into that, and think about where that's going to be. We still have a little bit of catching up to do, not a lot. I think candidly, having the supply chain issues resolved,
Right.
which were a huge issue throughout 2021, led to a lot of inflation, et cetera. I know we're going to talk about inflation later. Having those supply chain issues resolved will also provide a little bit of a positive tailwind for the economy in 2022. So, not certainly not the banner year that 2021 was, but I don't think anybody's looking at 2022 and is nervous about where GDP growth is. Knock on wood.
Mm-hmm, mm-hmm. So you had a great comment about lessons learned for clients in relation to last year. Can you share that? I thought it was very insightful.
So two things. One we touched on a little bit earlier, right, which is the whole growth versus value debate. And when you look at the S&P 500's growth sector, once again, those Netflixes and Facebooks and Amazons of the world. 31% returns. Okay, so large cap value stocks are 22% returns. So certainly not bad, but still underperforming by almost 10 percentage points. The Russell 2000, so small and mid cap returns, was about a 13.5% return. Certainly not a bad year, right? However, when you compare them to that 31, it certainly starts to look a little bit tough. And then international returns were 5% last year, which once again, a positive 5% year, not great for equities, but not terrible. But when you compare it to those large cap growth companies, it certainly there's a lot of headroom there. And so, this is not certainly the first year that this has happened. It's been about 3, 4, 5 years in a row now that U.S. large cap growth has outperformed. That won't continue forever. But trying to call when that's going to stop is exceedingly difficult to do.
Yes.
And, it's one of those things. When we went into 2021, all of the talking heads were talking about this is the year for value, right? This is the year everything's lined up. The consumer's going to start spending again. And that's great for, airline manufacturers and, restaurant companies and all these other sort of old line value stocks. And it turned out, nope, that actually wasn't the case. Large cap growth still outperformed.
And they were all on the political front as well, saying, the sky is falling. We've got this new leadership. And so we're going to have all these new taxes and all of this legislation and all this stuff going on that, that's going to crush markets.
Yeah. And none of it happened.
Right.
Yep. So the talking heads like to talk a lot. Sadly, a lot of times the reality is that what you do when you're reacting to some of those things is almost always wrong. It's sad, but it's true. But I do remember, number one question that we got this time last year was just around, politics and capital gains, taxes, and what does that mean? How is that going to change the market
volatility,
and everything else?
big time.
And none of it happened. And based on current consensus in Washington and what it looks like coming into the midterms, which are just around the corner, it doesn't look like any of that's going to happen. And so I just remind clients as a takeaway lesson from 2021. If you're worried about something that you think is going to happen in Washington, do not invest on it until the ink on the page is dry. Because until that actually happens, and that stroke of pen has signed it into law, there's a lot that can happen in the political process to derail those types of predictions.
Right. And two, the thing that stood out to me in 2021 was not really what stood out, but what didn't stand out. And normally we would be used to some degree of volatility. And it just, we got it a little bit in the fall, but just not there. And it almost, sort of makes me nervous, looking forward as we normalize, that are those times where markets, get a little rocky there. Are those going to return? And when they return, how trusting of us as the advisor are clients going to be? And those new clients that are with us who maybe haven't been there with us 20 and 30 years, that's going to be a new experience because we haven't had it. Been.
And I think it is up to the advisor to help coach clients on, there is this concept called recency bias, right? Like we expect, we have very short-term memories, right? And once again, I remind everyone that 12 months ago, we were all living in our basements and vaccines weren't really a thing. That seems like ancient memory. But yet in the context of a market that moves in, 5, 10, 15-year cycles, that was just around the corner. You're right. Last year was not the most volatile year. I think it will scare some people a little bit when we get a more normal year.
Mm-hmm.
But I just remind people that last year was the abnormality. Normally we see markets move around by 1 or 2% a day. That's okay. There are only about 250 trading days in a year, plus or minus. And when you start to think about, 1% moves, you normally get 1% moves on 60 or 70 of those days. Last year was about in the 40s.
Yeah.
So, it's one of those things that, when we start to see volatility return, it's always helpful to coach people on, this is actually normal, not what we saw last year.
Right. So you mentioned the business cycle.
Yes.
So how do you think, or where do you think in the business cycle that all of these things, like where are we? Like, did the pandemic, does that count as one of those recessions in your opinion? You look at all the stats, they say every 4 or 5 years, you're going to get a correction of, the market's going to go down 10, 15, 20%. And every, X number of almost every decade, you're going to get, a recession and things like that. So what is your opinion on, where are we in the ball game?
Okay, fair enough. What I would say is we are currently playing a sport that is ends whenever it ends, right? There is no inning count. What do you mean by that? There is no inning count. There's no shot clock or anything else like that. And I have a somewhat contrarian view on this, right?
Rick Waddell has a contrarian,
small contrarian view, right? Whenever you ask somebody like me this question, you almost always get the answer that we're late cycle, but we still got a couple years before something gets scary.
Yes.
Because if I tell you that something's going to happen 24 to 36 months from now, it's the perfect timing. Because if it doesn't happen, then you'll forget that I said it. You'll forget that I predicted it. So it's the perfect length of time for me to say, we're late innings, we should be cautious. The reality is, all of these studies that say, a recession should happen every 6 years or 3 years or 7 years or whatever it is, are all predicated based on this notion of the U.S. economy being this static thing, and it's not, right? So back in the 1970s, we were 70% industrial. GDP was 70% industrial production. Now GDP is more like 75% consumer spending.
And that's a huge shift.
Massive shift. And so when you start to look at all of these cycles, economic cycles that happened sort of pre-1980, all of those happened under a very different economy. It's sort of like saying, should the United States economy behave the same way as, Argentina's or Brazil's or one of these other economies? The answer is no, it's not comprised in the same way, right? Like they're just two fundamentally different things.
Right.
And so as a result, all of these studies that are like, oh, well, a recession happens on average every 5 years or whatever else. It's like, well, what time frame are you really measuring that over? And what did the U.S. economy look like? Because actually pre-1980, recessions were more like every 3 or 4 years, right? And they were dominated by the inventory cycle. And you could kind of just tell. I mean, it was easy to predict when recessions would happen because when inventory started to get really fat in the channel, you knew that eventually people were going to start to cut that inventory down and we would, get a little bit of a recession. Right. And then when inventory got too thin in the channel, we'd start to overproduce to restock inventory and you'd get an expansionary phase. Here, GDP growth really in a 75% consumer economy is really much more driven by when you get your paycheck, do you decide to spend 90% of it or 95% of it, right? And that's a very small change.
It sounds like not a big deal.
It sounds like not a big deal, but when collectively everyone decides to do it together, that's what drives recessions. And actually, this is funny. Most people don't believe me when I tell them this. Take a guess. How much did total income, people's paycheck, drop during the Great Recession?
During the Great Recession.
During the Great Recession. 2008, how much did incomes drop? Income.
Why would it have dropped? I mean, unless you were...
Well, people lost, everybody's lost jobs and this and that and the other. People,
but if you were
up.
Still employed.
But if you were still employed, how much did your income across the country drop?
15%.
Less than 0.5%.
What?
Less than 0.5%.
Wow.
You can go back. That was the peak to trough drop in income, but spending, GDP contracted by almost 10%.
Which is what mattered.
Which is what mattered because people stopped spending their paychecks. They got scared, right? They got scared, which is what created the recession. And actually, the same thing happened in the pandemic, right? Our savings rate went from 7% to almost 35% because people got scared and they stopped spending money.
Right. They stashed it.
And it's not, it's that level of activity that actually drives the recession. It's not the a bunch of people are going to lose their jobs or this is going to happen or that's going to happen. It's more like, no. Everybody just collectively freezes at the same time.
Right.
And decides that they're not going to go buy that new car, they're not going to build that new house, or they're not going to do this, that, or the other, that actually leads us into the recession. And the corollary to that is, if you can tell me when people are going to get scared again,
then you can tell me when the ball game.
Yeah, then I can tell you what inning we are in the ball game. Right. But if you can't predict that, then you can't really predict when cycles end.
Right. Which for people who are retiring or about to retire, I mean, that is a huge thing because if you were, you're really looking to manage risk at that point and that volatility and that, the economic growth going down backwards, it's going to have an effect on markets and that's going to have a negative effect on portfolios. And if you lose 50% in your portfolio, it's going to take you 100% to get back to even. So that's not. It's
very, very, very true. And what I would say is, if you live in a floodplain, right? I know that floods are going to happen, right? So if I live in Houston, I know that a flood over the next 10 years, it is likely that a flood is going to happen, right?
Right.
I don't know when. Right? I can't pinpoint a date and say, yep, it's 3 years out or it's 6 months out or whatever else. But I can tell you this, I can't start preparing for the flood when it starts raining, right? I can't let myself do that. So what you have to do with your portfolio is say, okay, look, I know a correction's going to come, right? I know that we're going to get a market downturn. Right. I know that that's going to happen. I know I'm not really going to be able to predict it with any degree of certainty, right? That crystal ball just doesn't exist. So I'd better make sure that I construct a portfolio from the outset that is set up to go through that type of cycle. Because if I wait until the cycle starts to try and build it, you'll make the wrong decisions.
Exactly.
Right?
Exactly.
There you go.
Perfect. So let's get to some top client questions that we've been receiving. So probably number one question is, can it keep going?
Yes. And the short answer is yes, with the caveat, obviously, that at some point we will get a correction, right? At some point we will get a correction. At some point we will get the next bear market, this bull market cycle will end. However, trying to predict when that ending actually comes is a fool's errand, right? There are a lot of people that would have looked at, whether it was markets in the late 90s, early 2000s, right? People would have looked at those markets and said, this can't continue. And if you're wrong...
And they are saying, ooh, inflation, and
inflation,
1970s.
This, that, et cetera. Same thing at the beginning of this year, right? Or beginning of 2021, people saying, this growth bubble can't continue, or this growth expansion, this growth, relative to value separation can't continue. Well, they were wrong. right? It actually did continue for another 12 months, and it may continue for another 12, 18 months, 36 months. Who knows, right? I don't necessarily know when that mean reversion will happen. I can tell you eventually it will.
Right.
The U.S. economy is growing fantastically well. If you look at corporate profits for the S&P 500, they are up over 20% relative to where they were pre-pandemic.
Which that's huge because, you think, okay, well, of course they're up with the pandemic,
right?
But pre-pandemic, that's
yes,
huge.
Pre-pandemic, they are up 25% corporate earnings, which is one of the reasons why the stock market is up as high as it is, right? Corporations have used the opportunity during the pandemic to trim down a little bit. They have come back leaner and meaner. They are making a lot more money. And so when I look at that, and then I look at where the U.S. economy is from a potential GDP standpoint, then yes, it can continue. We do get a lot of questions on inflation, and I know this is a concern for folks. What I would tell you is inflation is not just a function of, well, there's a lot of things tied up in that inflationary question. A lot of them are supply chain related. If you talk to most economists, they think that we've actually passed peak inflation because supply chain issues are getting fixed or have been fixed. And so now, we
just
worked those issues through the system. And so inflation will start to go back down again. That doesn't mean, by the way, that prices go down on average.
It just companies will still be.
It just means that they stop going up, right? Yes. So, inflation is out there. There are a lot of people that say we printed a lot of money. My response to them would say that, yes, we did issue a lot of money, but a lot of that money didn't go anywhere. So the velocity of money didn't change. And so, your effective supply of money is the amount of money that's in circulation times the amount of times that those dollars transition. So that's less of a concern. And the Fed is actually in the process of subtracting some of that money from the system. That will start to calm down again. And the last thing that I would say, and this is a very subtle point, but it's maybe a key client takeaway. The number of people that come to me that say, inflation, this is a huge problem. I'm scared. The immediate question that I ask them is, okay, well, but if you're scared about inflation, like, what do you want to do about that? And the response is, well, it feels like we should be in cash, or we should be in gold, or we should be in energy. We should be in something. We shouldn't be in equities. And the reality of the situation is, cash and fixed income securities and some of these other, places that people think are traditionally safe places to stick money are actually those places that are hurt the most by inflation. And equities actually benefit from inflation because the value of those companies goes up as they just inflate their income statements and inflate their balance sheets. And so if I would tell you as an economist that if the only thing that you're worried about is inflation, you would actually want to own more equities, not less.
Just deal with the volatility.
You just deal with the volatility and make peace with it. And it is one of those things, key takeaway for clients. Sometimes when you get scared, what you think you want to do is, once again, exactly the wrong answer for what you should actually do, which is a recurring theme.
Yes, it is a recurring theme. No. So it also dovetails into, I hate bonds. I used to like bonds. I hate bonds. Why should I own bonds?
And why would you own bonds?
And I know that there are a lot of different types of bonds out there, and it's been a search, at least in our office, I would think, like most advisors' offices, to try to be in the types of bonds that are going to be more resilient at this point in time. Sometimes you're right, sometimes you're wrong, but there are lots of, you can't just label it and go bond. All bonds are bad, but I know you have a great client takeaway for that.
Well, so I'll just say a couple things. The first is, let's acknowledge the Warren Buffett problem. Okay. So Warren Buffett is famously on record for saying, I don't know, bonds are the greatest ripoff in American history, and no one should ever own a bond. And I don't understand why anyone would own a bond because, and his reasoning is, and it's not wrong, is that over any long period of time, you earn more money in stocks than you do in bonds. And he's not wrong on that. So if the only thing that you care about is absolute return, then no one should ever own a bond, and you should just own 100% equity all the time. And that is what Warren Buffett does. And that's no problem for Warren Buffett because Warren Buffett has $1 billion, right? Plus or minus, probably more than that, actually. So it's not a big deal for Warren Buffett if the equity market drops 50% and he only has $500 million. He will still be able to make his mortgage payment and make his car payment and pay for his health care and eat and go out to dinner and do all of those things because he'll still have $500 million. So for Warren Buffett, this notion of like, yes, I should be at 100% in equities the whole time makes a ton of sense, right?
Right.
For the vast majority, if not all of the clients that I talk to, they do not have $1 billion, right? They have something that is, an order of magnitude smaller than that. Some cases, several orders of magnitude smaller than that. And as my beloved friend Tommy Williams down in Shreveport used to say, our clients like to eat every day. And it's true, right? Like if you're in the stage of your life where you are living on the distributions from your portfolio, then you
might
be soon,
might live,
right? Or might live soon. Then you care just as much, if not more, about the volatility of that portfolio.
Right. Not eroding
the value of that portfolio.
Yes.
Then you do the absolute return. And the fascinating thing is, and for those of you who are engineers out there, you will understand this, because fixed income securities and equity securities are negatively correlated with one another, then I can actually get a larger proportional reduction in your volatility without a proportionate reduction in the expected return, which is a weird way of saying like I can take significantly less risk and not give up that much return to do so, which is what you do when you invest in bonds.
Particularly when equity markets may be starting to start to level off a bit.
And so I talk to clients all the time and they say, well, why do we own these bonds? My equities got, and let's ignore last year. Like last year is a particularly bad example because equities returned, 20%, 25%, and your bonds returned -2. Right? Or -1 or whatever that is. And so the comparison is very stark. But this argument, like I've been hearing this argument from select clients, for years now, where it's my equities returned 15 and my bonds returned 7 or whatever it is. Why do we own bonds? And the answer is you don't own bonds because of what they return on average, and you don't own bonds because of what they return most years. You own bonds because of what they do in 2001 and what they did in 2008 and what they did in March of 2020. You own them for those very particular moments in time where it's like, actually, I don't want to ever encounter a period where my entire portfolio is down as much as the market is.
Correct.
Right?
Correct.
And so it's that. It's
factor.
It's that buffer factor as to why you own those securities. And time again, we own bonds because as opposed to other buffering categories, they provide the best return return safety characteristics out there that we can get. If there was another safer asset that wasn't correlated with equities or had negative correlation with equities that had higher returns, we'd certainly look at that.
Right.
But so long as the U.S. Treasury and the bonds that are tied to it, investment grade U.S. securities, are going to be the flight to safety play in the globe, which is what they are. Then you want those assets in your portfolio for the negative correlation that they have with equities. Right. And that's the reason why they're there.
Right. And too, on those times when, the market goes down, if you needed money, boom, you can go to that piece and you can take a little slice of that, throw it in that market, if that's your risk tolerance. So they do have a purpose.
They do. They absolutely do.
They do have a purpose.
Absolutely do.
Okay, let's see. Other client question. Probably biggest opportunity. Biggest opportunity and biggest challenge
Opportunity and biggest challenge.
Yeah.
I think that these are linked with one another, right? As the old Chinese proverb, the word for problem is the word for opportunity. You know, um, I think that this whole growth versus value and small cap and international is will eventually correct, right? When you look at where
Meaning the guy that has made money in the last 5 years will not be the guy that makes money the next.
yes,
That's what you're referring to, right?
yes,
Okay.
that eventually we will return to a time period when the returns amongst asset classes are a little bit more favorable, a little bit more comparable, or said differently, small caps and value-oriented stocks have become so cheap relative to the growth stocks that we get the correction where you actually earn more for owning some of these smaller cap companies or some of these value companies as opposed to some of these growth companies.
Mhm.
And I think it's a big opportunity for those who are brave enough, or for those who are willing to study the markets for a long historical time period, to say, yep, you know what, these types of cycles come and go.
Mhm.
And this one certainly seems maybe a little long in the tooth. I can't tell exactly when it's going to end, but I know I want to have diversification on both sides.
Right, right.
It is a problem because we all know clients that are out there that, their buddy has owned Fang now for the past 5 years.
Right.
Fang, Facebook, Apple, Netflix, Google, like whatever it might be. Um, they've just crushed it. They've absolutely crushed it. And so they're convinced that they've found the secret sauce. And it's very hard to convince those people that actually what you found is you've been on the right side of a very narrowly diversified bet for a while now.
And that sauce can give you food poisoning too,
Right,
and that
exactly.
really is a bad
And
experience.
it's a bad experience. So it's one of those things. It's an opportunity for those folks who are willing to say, like, okay, look, I should take a little bit more diversified approach, and I'm willing to own some of these more unloved sectors of the economy because I think that it's going to come back.
Mhm.
And so I
Mhm.
think there's an opportunity for outperformance. It's a problem because when people there's a thing out there called self-attribution bias, okay, which is basically this notion that when we succeed, we believe that it's due to our innate skill. Right? Like, it just is like, this is, Google it, self-attribution bias. When we succeed, we believe that we just have this, innate skill, and it's due to us being better than, everybody else at whatever else it might be that's out there. And, I called Google or blah, 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 blah,
Mhm.
blah, blah. And more importantly, and well, perhaps equally as importantly, when we fail or when something doesn't go right for us, we normally attribute it to some sort of factor beyond our control, right? So we'll use relationships as example. I'm in a successful relationship, and so that must be because I'm so good at communicating with my partner, and being a wonderful significant other, and all of those other things. And those relationships that ended before me were all the fault of the other person, right? Like, that didn't have anything to do with me or my communication style. It was just because they were so troublesome or whatever it might be, right? In Stockland, it's, I'm so good. I called Amazon because I knew the first time I heard about Jeff Bezos, using doors for desks instead of actual desks because they were cheaper. I knew that guy was the guy that was going to be, leading the economy to success. And no one could have predicted when oil prices went from 120 to 20 and I
No.
lost all that money and all those oil and gas investments. That was a factor beyond my control. And if you listen to this, when people talk about their successes and failures, you can hear it. And the reason why I mentioned it as a problem is because, once again, we're going to have a lot of clients, a lot of prospects, a lot of folks out there that are like, well, why don't I just own the Netflixes and Googles and Facebooks of the world?
Mhm.
It feels
They
like I
did.
can
They
make this
did
call.
well the last X time period. Surely that trend will continue.
Yes, and it is the hardest client to try and talk to because they are the ones that can, history, any type of data analysis, anything else like that would suggest that they're wrong.
Right.
But they have the experience of being right, and that experience is very difficult to combat.
navigation is key, especially when we have gone through what we've gone through and we're having a kind of a reset period.
Yep.
So, all right. Last question for you. So, what do you think the main value that investment advisors bring in a world like we are about to experience?
It's a great question. And it's obviously a self-serving one. So I'm going to cite a lot of data that you guys can Google at home to go look at. Okay. The process of financial advising and financial planning and investment selection in and of itself is not rocket science. Okay.
We think it is, right?
We think it is.
I thought, what was that self-bias? What was that?
Yeah. Self-attribution bias. Yes.
Yes.
I'm the only one that can do this. That's a load of malarkey. There are entire sections of books at your local library on investment management and financial planning. There are online courses you can take.
If you want to do it 10 hours a day,
if you want to do it, you can. And the analogy that I like to give to people is around auto insurance, right? So when was the last time that you rebid your auto insurance?
I didn't. I don't.
You don't. You just get the renewal notice every year.
I go, this is a great company.
Right.
And I'm done. Here's the check.
You just renew the the auto insurance every year, right?
Right.
Why?
Because it's a great organization.
Yeah,
and I know they're going to take care of it.
But don't different auto insurance companies give people different rates based on their driving history and based on their age and stage?
Cannot get something for nothing.
Exactly. Blah, 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 blah. And the reality is that if every single one of us every year when our auto insurance came up for renewal went out and bid out your auto insurance, which there are very easy online tools to do, right?
We could do it.
It takes 10, 15 minutes, according to Geico. I think it probably, reality takes maybe like an hour and a half. But if you did that every year, then you could probably save yourself a couple $100 a year on your auto insurance. And since most people's auto insurance costs, I don't know, like $2,000, somewhere in that range, like you're saving a meaningful percentage on your auto insurance if you would just go out and rebid it every year. But people don't. Why? Because they don't take the time, right? They just don't think about it, right? And your investment performance and your financial performance is the same way, right? So if you didn't sit down in the last 2 weeks of December and go through every holding in your portfolio and look for individual tax losses that you could take, then you left money on the table last year.
Yeah,
right?
If you had a non-taxable portfolio.
If you did not if you had a taxable portfolio, if you did not go through and rebalance at least once last year, if not two or 3 times.
Meaning take your gains, reinvest them in buying the things that were lower.
Yes, exactly. Bringing your portfolio back to normal. Then you did yourself a disservice. If when you were taking money out of your account, you did not put it back into balance in the process, or if when you were putting money into the account, you didn't do the calculations to put it back into balance as you were putting money into the account, then you did yourself a disservice on transaction fees. All of these things go into what's known as the performance gap, and you can Google it. Vanguard did a study, and they call it about 3 to 4% a year. There are other studies that are out there, but they all kind of help to explain why, on average, the do-it-yourselfers don't do as well, particularly on an after-tax basis, as the folks who work with a financial advisor. And the interesting thing about that is that actually ignores all of the other value that you get
the
from
financial
working
planning
and the estate planning and
tax planning,
everything else that goes into your relationship with your financial advisor. And it's really funny, so if you're like super narrow focused, you can look at it and say, okay, well, on average, I know that the data would suggest that, investors, I actually return more. Despite the fees, despite everything else that everybody wants to talk about, on average, the data is crystal clear. You get more return working with a financial advisor than you do with doing it yourself.
And a lot of that is risk control, like you don't lose as much.
Yes. A lot of that is risk control. A lot of that is actually behavioral modification.
Yes.
Believe it or
not.
Yes. Then we look at all the services that you quote unquote get for free associated with it in terms of the estate planning and financial planning and, tax planning and all of these other things that goes in, insurance consultation, all of that kind of fun stuff that goes into what a financial planner provides for you. Okay. And then last but not least, you start to come to, and this is a study that is actually just recently, about 6 days ago, quoted in CNBC, which I think is hilarious, by Herber and Company, that show that individuals who work with a financial planner are 3 times happier on average than people who don't, right? But largely because they're like, I don't want to worry about it anymore, right? Like, I just want to know.
They don't want to have to navigate.
Right. This aspect of my life is taken care of.
Right.
I know, I don't have to sit there and worry about, am I buying a new car? Am I financing that? If I'm financing it, like, what rate am I doing? Am I going to lease it? Am I going to just pay cash for it? Like, what's the best? Like, I don't have to worry about any of this because I just call my financial advisor. They tell me what to do. And like, I know I'm going to be fine at the end of the day. And it's interesting to me that study came out of CNBC, who is the champion of the folks like Jim Cramer and everybody else.
Do-it-yourselfers.
The do-it-yourselfers. They're like, you don't need these people. Just get educated and you get in there and you can do this yourself. When they actually sit back and look at it, they publish a study that's like, actually, most people would be significantly happier if they just let somebody else handle it for them and figure out something else to spend their time on.
Well, and I think one of the most rewarding things that as we work with more and more of your family members, I mean, this actual coaching of, all of the kids in the family. I mean, there's so many questions around, they want to do the cryptocurrency or they want to, maybe they're not traditional savers or they've got a stock portfolio on Robinhood and they think investing is, putting X number of dollars into, Microsoft themselves. And so part of where I feel like our help to clients can be on the preservation end is making sure that when that money transitions, that those children of our clients are starting to make smart financial choices as well, so that the planning of the parents dovetails into the kids. That's just as important. So,
like it. Completely agree.
All right. Well, cheers to 2022. That's what's brewing. Thank you for joining us. Take care. Happy 2022. Thank you, Rick.
Thank you, Sherry.
All right.
If you're looking for a comprehensive wealth management team, we welcome the conversation. Look us up at invresource.com.